Thank you very much, Amanda. Please. Good afternoon, everyone. I'm very happy to be present here at the Singapore FinTech Festival. I am honored that I have two very distinguished guests joining me this afternoon on this panel on balancing innovation and with consumer protection. Before I introduce our two panelists, perhaps let me just take this opportunity to set the stage with respect to this panel. Now, the rapid pace of fintech has transformed the financial services industry, and it offers innovative solutions such as AI, blockchain, and tokenization. All these innovations and technology enhances efficiency, accessibility, and convenience. However, despite having these demonstrable benefits, these innovations also pose risks that regulators and authorities must address. These risks include cybersecurity threats, data privacy concerns, consumer protection concerns, and the potential for financial instability. Regulators and central banks will play a critical role in adopting an adaptive approach that balances innovation with addressing risks. Now, this afternoon's panel will attempt to address the pertinent issues around how central banks and regulators foster innovation in fintech while ensuring consumer protection, particularly as this financial sector grows rapidly. Now, I have the privilege of having two distinguished speakers joining me this afternoon. On my left, I have Dr. Eva Hüpkes, Secretary General of the International Association of Deposit Insurers. And Eva has very kindly informed me that the International Association of Deposit Insurers should be referred to as IADI. Yes, IADI. All right, thank you for that. And on her left, I have Christoph König. Christoph is the Deputy State Secretary, and he is the Head of Policy Planning and Strategy Division from the State Secretariat for International Finance. Now, as we begin this session, I will start off with Christoph on the broader topics of key risks from emerging financial technologies and how SIF addresses these challenges from the perspective of safeguards and collaboration. So maybe I could ask, in your opinion, what would be the key risks emerging from such new technologies as AI and blockchain, particularly from the consumer's perspective, and what would be the safeguards that SIF is advocating? And more importantly, how would SIF balance the need for fostering financial innovation while ensuring robust consumer protection in these emerging technologies?
Thank you, CT. I think first and foremost, it is important to stress that we all are living in frameworks that already exist. We have a clear task as a regulator to ensure stability and financial integrity, as well as to protect customers, investors, and creditors alike. So when trying to embrace innovation, it is always important to find a way of striking the right balance between allowing the innovation and at the same time also not losing sight of the important goals that you have, that is providing stability and integrity. So the consumer protection is at the heart of a regulator. However, also we know that innovation is taking place. It is taking place sometimes outside the regulatory framework, and so we need to understand and also to learn from the market in which ways actually these new developments do occur. What we have seen over the years, I think we have embarked on a journey of digitization 10 to 12 years ago when it was fintech sandboxes, and we just learned how actually that there may be new ways of banking and providing banking services. and we tested sandboxes, we tested new forms of licenses, simplified licenses, and it was very difficult. But then we all of a sudden realized that there are many more items that may occur, like cyber incidents,
Yes.
As well as operational resilience, which due to the further use of IT systems became more prominent, and we had seen new risks evolving. Later on, we had the developments in DLT technology, which have taken place in Switzerland. We have tried to introduce a law providing a framework for DLT technology back in 2020 that allowed actually then innovation to thrive. All this to say that the regulatory framework was adapting, but only slowly. However, what it also showed that the regulation provided the framework where innovation can drive. Without having a predictable environment, it is difficult then also to set innovation on a sustainable footing. However, your question was then what happened further? Yes. New risks that evolved, or just new developments, AI, as well as further developments in the area of tokenization and crypto. And we clearly see there are new risks evolving just as we learn how the technology is being used. In the area of DLT, we certainly see that crypto may be used as an asset class, not just as originally thought as a payment token. So we see many issues how this actually relates to risks relating to market abuse as well as to consumer protection. Second, certainly what we have seen in the area of stable coins most prominently were a rise in the use of stable coins for remittances. Then the question has arisen to what extent AML issues and also sanction compliance risks that may be involved, how we should and could address them. And that's only a few items that are left in the crypto and DLT space. However, what was even more important and should not be forgotten, the real dangers for stability that are cyber risks, as well as operational resilience risk as more and more financial intermediaries are reverting to third-party providers. And there we see a clear element of potential concentration risks that need to be addressed. It's not directly impacting the consumer, but indirectly, if stability is endangered, then also it would affect the customers at the very end. And last but not least, now with the rise in AI,
yes,
we see a new development which has been unknown to us. I think we have started working in our office 3 years ago on AI. I'm quite grateful that we didn't produce a report back then, because what happened the last 20 months was just incredible. And we just see the first, I would say, contours of what may be potential risks in this area, certainly on AI ethics or on what kind of models are being used and what kind of risks are entailed with that. So with that, I leave it for the moment.
Thank you very much, Christoph. I think that was very insightful, and I'm certainly would like to pick up this point about AI. As you said, you know, whatever that's written about AI right now in terms of rules and regulations, by the time it's published, it's obviously going to be obsolete, because the new technologies and new developments will certainly overcome, you know, and you know, just basically outrun and outpace the pace of the developments. I think regulations will obviously need to pick up speed, and the understanding of central banks will also need to be enhanced in order to respond accordingly, you know, to these new technologies. And maybe perhaps at this time I could now invite Eva then to share specifically from the viewpoint of challenges for deposit insurers, specifically how they need to evolve as financial services become increasingly digital. So the specific question here is, would you foresee any specific challenge for deposit insurers in adapting to the rapid pace of fintech innovation, particularly concerning digital assets, decentralized platforms, and cryptocurrencies?
Sure. Thank you very much. Absolutely delightful to be here. And before I answer your question, let me tell the audience quickly who IADI is, the International Association of Deposit Insurers. We are actually also based in Switzerland, so we both come from Switzerland, at the Bank for International Settlements in Basel, so next door to the Basel Committee and the Financial Stability Board that many of you may be aware of, and CPMI, the Committee on Payment and Market Infrastructures. And our members are the deposit insurers from around the world. We have about 100 deposit insurers from 96 countries and a few other financial safety net participants like central banks, including actually the Monetary Authority of Singapore as associate members. And we are the standard setter for deposit insurers. And our core standard, the core principles of effective deposit insurance systems. And one important, and this is now the response to your question, so what are the concerns of deposit insurers, is about depositor protection and public awareness. With the emergence of so many digital products that then are maybe advertised as having features that are similar to the traditional bank deposits, the consumer may be confused, and so there is an international standard and expectation that deposit insurers inform about coverage, that insured deposit-taking institutions also inform about coverage, and that in jurisdiction there is also so basically a prohibition of misleading information about coverage where there is none. And so this is important to maintain trust in the financial system so that depositors know where they put their money, is their money safe, what are the risks, and with the emergence of just so many digital products, that e-money, it is no longer clear to the man on the street or the woman on the street what is subject to protection and what isn't.
Okay, thank you. Maybe I could just ask the both of you in terms of your views on AI. Now, increasingly, financial services are depending on AI for the provision of services. How do we then ensure that the use of AIs and algorithms in financial decision making? Whether is it regulators and policymakers, how would they ensure that these AI innovations do not inadvertently disadvantage certain consumer segments?
I think as a generic view on AI is, it will be used and will be useful and purposeful in the financial markets if it may instill trust. So if it is not ready-made and not able AI algorithm to provide more trust, then it may not be used, neither by the financial intermediaries, nor the customers, nor the regulators themselves. So ultimately the test will be, may AI increase the trust and resilience between financial intermediaries or for financial interactions. It may even be that AI can replace financial intermediation. So who knows? I think first and foremost these days we just don't really understand what may happen. So the first thing that we need to do is certainly try to, as a regulator, try to really have a clear view and understand what is happening on the market. So far as we see it also in our engagement with the industry, it is about to be tested in pilot cases, in rare cases. However, I have rarely seen an algorithm or just a AI model providing and replacing a relationship manager of a private bank. So far we are not there yet.
Okay.
However, we need to identify what may be the issues. And first and foremost, the first line of defense these days is certainly that the financial intermediaries themselves do address the potential risks. They have to look into what may happen, and they have to attribute the responsibility within their own organizations to really care about the potential risks that it may entail, not just for their organization, but also for their relationship with clients. And so we also already have actually a framework that does address potential risks. So stability and financial market integrity are issues that are looked at from a regulatory perspective and also supervisory perspective. And so AI is just a continuation of technological advancement that is being applied. So we need then also to understand what the concrete risks may be. Today, we have seen AI models already being used for process automation, but also for algorithmic trading. And we also have seen AI trading with other AI models. So some experience does already exist in the markets, and so these are not new. When it comes to Gen AI, certainly we see that the usability to create text, coding, but also process larger databases, that is something which may be new, and it's still in the testing phase in most organizations. We see clear risks and a variety of risks that may arise. That is, financial crime can take different forms. We already see now an increase of deepfakes. This needs to be addressed. Certainly in the area of model risks, how models and how we can have a transparent view on models. They need to be scientifically clarified. We need to have a clarity about explainability of how they come to results. Then the discrimination bias that is inbuilt depends certainly on the data quality, and also there, I think just having more transparency on databases used may also be an element of mitigating these risks. So I think we are now at the stage just in engaging very closely with the firms concerned, be it locally but also internationally, and the more cooperation we have, the more information exchange we can have on the potential risks that we see amongst the regulators but also amongst the firms may help us also ultimately to address the risks.
Thank you for that. So I guess when we look at the use of AI from policymakers' perspective, I think we are able to understand it and we are able to identify mitigating measures to address the risk. But from a consumer's perspective, if I'm a consumer and I go to a financial institution for financial services, whether it's to take up a loan or to place my deposit or to perform to invest in certain funds, and I'm told that the AI algorithm is behind all these decision-making points to determine whether I will have access to these services. What would be the best way to address such the balance between policymaker putting in all these mitigating measures, but at the same time raising consumer awareness and educating consumers with respect to how AI is used in these financial services? Maybe perhaps Eva, from your perspective, would you be able to share?
The IARDI is at this stage actually in the process of reviewing its key standard, the core principles of effective deposit insurance systems. Later this year, it will release a public consultation on this standard, and it declared, well, the aim is to future-proof the standard and make sure that it's adaptable to the changing conditions in the financial space. And I talked before about public awareness being key, and also the implications of the use of AI by the deposit-taking institutions themselves. One example is deposit aggregators that aggregate deposits and then just place them where, say, the interest rates are the highest. But what are then the implications say, for the individual deposit-taking institution and the deposit insurance if this happens in particular in a cross-border context. So there are new challenges emerging, including with respect to the insured deposits. So that's why we also expect authorities periodically to review the scope of coverage of deposit insurance to understand what is widely used and therefore deserves protection, and what is the issuer actually subject to prudential supervision and oversight, which is a key precondition.
Right. Okay. I'm mindful that we have about 6 minutes left. Perhaps I could ask Christoph for your views about, when we look at innovations versus regulations, there's always this tension between putting in place innovation-friendly policies versus policies that would cater towards protecting the financial resilience of the system. Where would you as a policymaker be able to strike that kind of balance? And also in terms of collaboration with the industry, what would be a model of collaboration between policymakers and industry to address innovation, allow these fintech players and even financial institutions to flourish with new products and services, but yet at the same time ensuring consumer protection?
I think it is always difficult to strike this delicate balance in ensuring stability, integrity as a regulator while allowing innovation and new ways and avenues for providing the services, or also using technologies for new developments. What is the most important thing is certainly listening to the industry and staying in constant engagement with them. That doesn't mean that you can adapt your framework from one day to the other. However, you need to understand where the problems are. If you would change every day your regulation, then it would not be a predictable environment that provides for legal certainty to do any kind of business. So it is not about innovating regulation, it is about embracing the innovation into the regulation. And certainly we have a few key principles that guide us. One is certainly innovation should be market-led. It is not a government office that can decide and see what kind of technology will ultimately be used. It is the market itself that knows what is deemed useful. Secondly, certainly, we need to ensure stability, integrity at the very end. So outcome matters. So we have taken a technological neutral approach to it, which means that the same business and the same risks are dealt with the same rules. And I think there we should need to allow for certain flexibility, because the rules, it is then determined by, does the rule ultimately achieve the same result in outcome? So, and the outcome should be protection of investors, stability and integrity, and still then innovation could be allowed. And last but not least, certainly, we need to take a proportionate approach which is ultimately risk-based. And together with these elements in constant exchange with the industry, I think over time you can slowly evolve your system, however not revolutionize like somebody somehow would have liked us to do.
Thank you. And perhaps one final question for Eva. In terms of the work that IAD is doing, obviously there's a lot of collaboration and partnership between the industry stakeholders and government authorities. Maybe you could share a little bit about, how would this partnership and collaboration with the industry help, enhance innovation, and at the same time to ensure that whatever risks that is arising from new technologies will be addressed
Sure. I mean, we've been talking a lot about the risks, but one also needs to mention the opportunities that arise with the new technology. And I mean, the objective of YADI is to protect depositors and maintain financial stability and trust, and to handle crises. And even in this changing world, I mean, you could maybe imagine a world with CBDCs where bank failures are a thing of the past, but in a world of fractional reserve banking, and we're not there yet. So stress and failures happen, and the objective is to use the technology to anticipate to the extent possible any stresses, and if they materialize, to manage them in the best possible way. And here, obviously, the technology, digitalization, digital IDs are an enormous help, and to ensure that depositors, even if their financial provider bank fails, can maintain quasi uninterrupted access to their savings. I mean, using technology to support the transfer of deposits to a new entity, or even the payouts so these are huge potentials that need to be explored, and the challenge for depositor insurers remains to, actually, the training, the skills, and using these new opportunities. And here, working with the industry is a way to do it.
All right, thank you very much. So, ladies and gentlemen, unfortunately, we have come to the end of our panel. It's a bit unfortunate that we didn't have sufficient time to continue this discussion with Q&A, but certainly thank you very much for your presence. And I would like to also invite the audience here to thank my two panelists, Dr. Eva and Christoph. Thank you.